Good morning, ladies and gentlemen, and a warm welcome from Gdańsk, from the head office of Grupa LOTOS. We would like to talk you through our consolidated financial results for the 9 months and the third quarter of this year 2020. A warm welcome to everyone who's joined us remotely. I think it's become a bit of a tradition, and I hope that at some point it finishes, that we've been hosting you remotely via the internet. This conference, of course, is live, and we also happy to take any questions from reporters that we take on our email account, media@grupalotos.pl. And if there are too many questions, we'll allow ourselves to actually address those questions individually if we don't manage to do it here. Our results are going to be presented by Wojciech Zenkteler, the head of investor relations with Grupa LOTOS, of course. Hello. And financial director Przemysław Krasicki. Good morning, Mr. Director. Good morning. So I ask Wojciech Zenkteler to take the floor, the head of investor relations, to talk us through the results. Thank you very much, Mr. Adam. Good morning, ladies and gentlemen. Everyone, welcome to this conference, to our results for 9 months and also for Q3 of this 2020. The pandemic reality is not only a necessity for us to run this conference remotely, but also exceedingly difficult conditions for business activity. And we need to stress time and time again that the past quarter has been the weakest quarter for the oil refining business in modern times. And we must say that the conditions are very hard, and we need to deal and cope under such difficult conditions. Hence, we are even happier to see us getting ourselves out of these conditions with a strong uptick, and we've been dealing really well. How does it translate into numbers? After 9 months, our EBITDA LIFO is 1.2 billion, which is definitely less than last year, but last year was a very good situation for this market, very good margins and demand. That's why we could deliver very good results. However, what we'd like to stress is this 1.2 billion. We would have had more than 1.5 billion had it not been for some methodological limitations that we have in the calculations of our LIFO results, which have caused that this calculation has seen of those historical expensive oil layers. And also what we talked about for the first semi-annual reports, but we also need to reiterate it time and time again. This quarter, 443 LIFO EBITDA and adjusted, and of course it's not 732%, and this has been caused by all those expensive oil layers that I've already brought up. However, as I've already said, under those very difficult circumstances, we can post such a result, which must be deemed good and allows us to consider this refinery as one which is geared up for the hard times to come. And those hard times and this difficult situation has actually struck. Those results, moreover, are also stressed by the parameter which is the most important or paramount for each and every business, i.e. cash. Cash flows after 9 months are 1.7 billion, which means that our cash liquidity is very good, and we are within the budgets. Our gearing ratio to EBITDA is 1.4. And another very important point is that we're very much and acutely aware that this energy transformation is a fact and has become. Hence, we feel fine with our energy efficiency and the reduction of CO2 emissions per ton by 2.5% year on year. That goes to say that we've got very good assets which have been prepared to the hardships of this time, to embrace green targets, and it's going to be even harder, and only the best ones will actually be well prepared. Dividend for 2020, I think it's a very important point. Only 5 companies out of the top 20 on the Warsaw Exchange pay a dividend, and we count ourselves amongst them. The board of directors have declared the dividend capacity, and it's going to be paid 4th year running. And we've been able to manage our resources so reasonably that this dividend has been paid. And the last point, but not least, of course, from the operational point of view, that confirms that this result is so good because we've actually continued to utilize the refinery capacity at 96.3% in Q3, which allowed us to post such very good results. If we could move on to the next slide now. This is the graphic representation. All the parameters I've talked you through. In the top left corner, you can see, of course, a drop in LIFO EBITDA year-on-year by 49%, which has been triggered by this microeconomic environment and situation. And I'd like to stress that this 1.56 billion would have been a higher result had it not been for the obstacle for the LIFO, expensive oil layers. And now the generated cash flows, operating cash flow, as you can see, is way better than what we've been, 1.73 billion for the 9th month, which is in the bottom left corner. You can see cash flows and cash in the business, which allows us to actually stabilize the passage through this difficult time. Crude oil throughput, as you can see, hydrocarbons production in the bottom right corner. We've been maintaining last year's levels relatively, currently even on a higher level, 21,000 BOE, and it has been boosting our structure. And let's move on to the next slide, please. Now we see the third quarter key highlights. Why don't I stop on the top left corner? We've got very important steps, drops, and an uptick. The result has been weaker because of the situation I've already quoted. The macroeconomic situation is incomparable to what we had in 2019. This 52 million you can see in the middle bar, this is a sort of a blip, actually, or disturbance which arises from those expensive oil layers. We're not better by those 340 million quarter on quarter. Net debt to LIFO EBITDA, of course, it's increased also by index, but of course it's a very safe parameter comparing it to other companies from this industry, and there are no reasons to be alarmed. Why don't we move on to the next slide? We're moving on to the external environment, and I give up the floor to Mr. Przemysław Krysicki.
Thank you very much. I'd like to now ask for another slide. And we start discussing the macroeconomic environment. As Wojciech has mentioned, with a very difficult macroeconomic situation of the petroleum sector, I'd like to stress that we're still under heavy influence of the pandemic, and we're exposed to the lowest margins in decades and lowest crude prices, which affects our financial results. But we'd like to show you also 2 graphs. The one on the left-hand side illustrates the global crude consumption to illustrate the impact of the lockdown which took place in March, April, and May 2020. As you can see, we saw a rapid drop in consumption by over 20 million barrels of oil per day. Fortunately, this drop rebounds quite quickly around June and September. We've returned to the level of around 95 million barrels per day, and the forecasts are rather optimistic and satisfactory. Things are slightly different in terms of the global air passenger dynamics. We have data of the RPK, that's Revenue Passenger Kilometers, published by IATA. And as you can see, there's been a significant drop in February and then through March and April. And it's a drop of 94% year on year, which means that this passenger traffic has been literally frozen. And unlike the global consumption of crude, the dynamic and the rebound is rather slow. Some forecasts and informations also even go as far as to tell that we will reach the pre-pandemic levels in 2023 or 2024 even, which will affect the jet fuel consumption. And now I'd like to ask for another slide. Traditionally, we will be presenting the macroeconomic environment versus our strategic assumptions, and we'll start with the Brent dated prices expressed in US dollars per barrel. And as you can see, our strategic assumptions have been quite different than reality, and it's almost 35% drop in the 9 months. In terms of natural gas, it's a 60% drop from $35 per BOE to 14 per barrel of oil equivalent. In terms of product crack spreads, our forecasts have failed to predict the petrol prices by missing the objective by 60%. Our strategic objective was $166 per ton. Currently, for the 9 months of 2020, the price was at the level of $67 per ton, and 45% difference between the estimates for the diesel prices. It's 117 versus 64 in the 9 months of 2020. Only heavy fuel oil shows a positive trend. We're still in red, but we see a 55% improvement. Moreover, in diesel, we need to take into consideration that the trend continues to be negative. The average pricing of product cracks is around $30 per ton, which means that the diesel crack price is strongly related to the GDP of states, and which has suffered greatly, and also it's affected by the low jet consumption. So the jet production is converted to diesel, and we have now a historical maximum of stocks of this kind of fuel, and this means that the trend is still decreasing. Moving on, as we can see, in terms of macroeconomic environment and the basic parameters, we consider the FX rate, US dollar to Polish zloty. The average exchange rate is dropping slightly between Q2 and Q3. We have 8 groszy difference. As for the GDP index, after the first very difficult quarter, second quarter, where we had almost 8% drop versus Q1, now we are improving slightly versus the third quarter of 2019, and it's 1.8% drop. As for diesel consumption, as I've mentioned earlier, it has been reduced. It has decreased due to the recession, but after the second quarter, which was the worst in 2020, with significant decrease, we are now seeing slight rebound in national consumption. We have returned to the level from the previous year in terms of diesel, and as for petrol consumption, it has even exceeded slightly the one in third quarter of 2019, and currently is at the level of 1.8 million cubic meters. Again, in the next slide, we have the pricing of natural gas and crude oil, and we see the decrease, which reached its lowest point in the second quarter of 2020, and a slight rebound in the third quarter, both for crude oil and natural gas. As for key product spreads, both for petrol and HFO, we've seen a rebound and the tendency has been reversed, and we are now coming back to a more regular, normal situation. But unfortunately, in terms of diesel, the trend due to macroeconomic and economic factors continues in negative. Thank you very much for your attention this part, and now we're moving to exploration production.
Ladies and gentlemen, we're moving on to our standard summary of reporting segments. You have the picture of our production assets starting on the left. You have the Baltic Sea deposits B8 and B3. I'd like to actually mark here that we've got an improving production on B3 deposits because we done our works, so reconstruction works on the drills which were closed on B3 deposit, and we couldn't have started those early because we didn't have the oil rig. The rig we bought at the end of last year from Maersk. Since early 2020 started this reconstruction effort that why we can boost the production from those fields, which is fantastic. Speaking of Norway, Sleipner has been producing on the level as expected. Heimdall on the wane, actually. Speaking of a trend, of course, it comes as no surprise as the level of reserves has been depleting steadily. That's why in the foreseeable future, the Heimdall fields are going to be partially phased out. And of course, we still need to produce in the fields around the Heimdall hub, which is related to all the projects that we are working with our co-concessionaries in Norway. Speaking of Åtgärd, the production has been below expectations of ours, of course, and this is what we see in the write-offs on those assets that we performed in the third quarter, and this is the ramification of the technical issues we've been experiencing with some specific drilling holes. There's too much hydration, actually. And now, just from this conservative point of view, we are writing it off, but we've been cooperating with the operator to make sure those issues are dealt with and production rebounds to the level assumed before. Let's move on to slide number 14. Again, we have a graph which depicts production in quarterly layouts. It's lower quarter on quarter, which is informed by the Utgard field, but it's higher year on year, speaking of sales. And sales has shown very good dynamics year on year. And what I've already said before, the bottom right graph, if you have a look there, the total contribution of crude oil in total production has been on the increase. That was our strategic objective in our philosophy of vertically integrated entity, that we produce oil, we process it, and we sell products. And in this production mix, would like to see an uptick in such production. And this traditional summary of how much we've produced since the dawn of this year and at what pace we are selling out our reserves. As you can see, we have a lot of stocks. It's quite a safe level of stocks or reserves. The reserves that are running out are just those related to Heimdall field. All the other ones give us still enough of a cushion for production for the years to come. And why don't we move on to slide number 16, moving on to results perspective. What we've been grappling with since the beginning of this year is the ramifications of drops in pricing of crude oil that results in write-off on assets, which actually were used for production, and of course the downward shift in oil pricing. That's why, applying the rule of conservatism, we need to apply such adjustments. But of course, they relate to the future. That's why if you would like to present this commercially effective and efficient ability to deliver flows through those assets, we would like to see those one-off phase-outs. And as you see, this adjusted EBITDA is 320 million worse than last year, 60% worse than last year. And quarterly approach, and of course what you could see in Q3 and Q3 of this 2020, especially in Q2, we were grappling with very low level of prices and quotes. That's why we had the highest level of write-offs, and as you can see at the bottom, and clean EBITDA at the level of 46 million in that quarter, and it's quite comparable to in this quarter, it's close to 100 million. And now moving on to production and marketing. Why don't we move on to slide number 19, the refining output structure. It's a very important depiction of how we actually act and how we try to adapt to this current situation. I'd like to first of all ask you to consider that we've maintained production compared to the previous quarter. It's lower year on year, and this is just impossible to avoid, inevitable, because as a majority of refining businesses, we couldn't have actually capped the same level. But please consider the structure: 17% of heavy products. This is our answer to the 17% of gasoline, actually. So this is our response. Good margins on gasoline and small margins on diesel means that we are trying to adapt ourselves to the situation. That's the 17%, which we've posted in this structure. And that's the reason for which we have achieved results which exceeded expectations. That's testimony to flexibility and adaptation skills and our ability to adapt to difficult situations. Let's move on to slide number 20. 9-month results. A drop, of course, is considerable. 846 clean EBITDA LIFO for the first 9 months of 2020. What I'd like to stress is the ramification of the same things we've said, so those expensive oil layers. The result would have been higher by 370 million had it not been for some methodological limitations that apply. One-off events do not amount to a lot, 52 million, as you can see, and as you can see, the operational result is negative, and that's generally the result of the trend of falling oil prices, where we have the average weighted. With dropping oil prices, these operational results will always suffer. The reported EBITDA minus 662. If we had oil prices growing, we would have this unnatural plus here. That's why we always clean the results, and that's why we present this EBITDA LIFO, you can see in the bottom right corner. Let's move on to page 21, which is the same in the quarterly depiction. 57% down on last year, and this is something obvious as a ramification of those difficult market conditions. But as I already said, with the worst quarter, speaking of those macroeconomic environment for this business, we must see this result as a very good one, actually. And let's move on to slide 22, the details of our activity in retail. We added this slide just to dive into the detail on our retail business activity. It's not encumbered so much by this macroeconomic situation currently, like the results for the entire segment. Demand or consumption at the pump in Poland in Q3 was good. The margins delivered were also on a satisfactory level. That's why 92 million of quarterly EBITDA and 179 after 9 months. The number of petrol stations, 511 facilities in total. Thank you very much. That's all speaking of segments, and why don't we conclude with consolidated financial results?
Now I ask for another slide. Now, moving on to consolidated financial results, I'd like to start with a comment on the most important factor, which is the clean LIFO EBITDA for 9 months of 2020. We have generated over 1.1 billion zloty. That's 49% less than in the comparable period of 2019, but take into consideration all the fallout of the economic downturn, we are very satisfied with this level. As for the decomposition of this level, this drop was affected by depreciation by 807 million, one-offs 879 million, and in the lower right-hand lower graph, you can say that the 879 million of one-offs was due to E&P assets impairments. In terms of the LIFO effect, which was mentioned by Wojciech, its impact amounted to 884 million zlotys throughout the 9 months. Of course, this accounting result, which is the net loss for 9 months, which amounting to minus 1.1 billion zloty, which is 1.9 billion less than in the same period of the previous year. Moving on to another slide, we see a similar decomposition. That's third quarter on third quarter of the previous year. Similar level of drop, that's 49% between the clean EBITDA LIFO in Q3 2020 versus third quarter of 2019. And I'd like to point out that this level is highly satisfactory. That's 433 million zlotys in such unfavorable conditions. That is positive information. The structure, as you can see, it's 259 million zlotys. That's depreciations, one-off 100 million. Again, you can see apart, we have additional exploration and production assets impairments. That was in Lotos, Norway. That was in the Yme and Utgard fields. Of course, all these impairments are non-cash events, and the LIFO effect minus 112 million zlotys. I'd like to note that this accounting profit is over 120 million higher than in the third quarter of 2019. Moving on to the next slide, we can see the traditional depiction of operating cash flows versus Capex. And as we've already mentioned, during the 3 quarters of 2020, the accumulated operating cash flows amounted to 1.7 billion zloty. In the last quarter, that was minus 55 zloty, but it was due to payables for services and supplies, which was the result of using factoring, which in the previous period has reduced the payable balances, and now they have returned to the regular level. And in the right-hand side, we can see Capex. Traditionally, the highest level, its exploration and production, is almost 2 million zlotys for Norway. That's Yme and Utgard, 90 million. That's the Baltic Shelf projects, B8 and Lotos Petrol Baltic. In retail, we have the growth of our petrol station chain, and in production, in refining, that's our strategic projects. That's the concluded investment of the hydrogen capturing installation and the EFRA investment that has also concluded, as well as the HBO investment, and 74, that's logistics projects, and we conclude with a total capex of 612 million zlotys. And moving on to the last slide, moving from left-hand side, we have a net debt which has been dropped, and that's the financial discipline and settling our liabilities has contributed to having this debt lower by 500 million zlotys than the same period last year. Half of the net debt is generated by recognition of the IFRS 16 leasing, which is a purely accounting measure. As for the gearing ratio, due to the lower net debt, the ratio has been also reduced and amounts to 21%, and half of it is the impact of lease liabilities. And the crucial index, that's net debt to clean EBITDA LIFO, we see a slight growth of the B14, but considering that it is highly affected by the low level of LIFO, EBITDA LIFO, this index continues within a safe margin. And that would be all. Thank you very much. Ladies and gentlemen, thank you very much for for your attention, and now for the questions from our reporters. I'll read through them. We'll start with Mr. Stempin from Argus Media. In the third quarter, the processing of crude oil was high in Gdańsk. How does the data from October look like, and what are the forecasts for Q4 given the risk of the pandemic measures tightening? Thank you very much for this question. As for the crude oil processing in October, ladies and gentlemen, as per our reporting strategy, every month we are communicating our processing to the external world, and it will be the same in this month. So we'll ask you for a bit of patience, and probably within 10 days from today, we'll present you with exact figures. As for our forecast for Q4, the situation is highly volatile, and this reality shifts from day to day, and we need to maintain flexibility in our decision processes. It is hard to discard a scenario in which we will be forced to adjust our production in response to the market situation and the market demand. Should this demand decrease substantially, we will not continue to produce stocks. But so far, during the pandemics, we've displayed high level of flexibility and capacity to react within a single week to changing situation. So we are confident that this optimization and dynamic management of supply chain will enable us to limit our production should need be. Thank you very much. Wojtek, your question also answers partially the next question from Ms. Monika Borkowska of Interia. How does the sales in October look like? Are the constraints affecting the sales volume? What are the expectations for Q4? And will the pandemic crisis affect the investment plans of the company, of the group?
And those are all the questions, or all three of those questions. I believe the beginning of that question has already been addressed. So actually, I can just repeat that, first of all, speaking of October, the reports will be published in early November, and production means sales because we produce to sell actually. So what you can see in our production data will be a cue with regard to what you can expect of sales. Speaking of investment plans, the company has currently been delivering on its business strategy and maintaining those projects which, within the framework of this business strategy, are being pursued. For now, it's hard to say how much we're going to adapt to this volatile situation, but of course there's a good dose of flexibility on our part, and I think our approach has been proven to be the right one to the situation, which you can see from the financial results. There seems to be no risk that investment is initiated whereby it could undermine our financial stability. Allow me to add that in Q4, we are following the plan with regard to the schedule on production and trade. We've just finished the HRO project, which is going to see its first launch and testing, and it's going to be opened to production 2021. Thank you very much for your answers to these questions. Ladies and gentlemen, of course, we shall be in touch with you individually as well. If there are any questions to appear throughout the day, over the weekend and on Monday, as of course we do understand you need to digest the data, so we are at your disposal and we shall get back to you individually. Thank you very much to you, the viewers. We do realize you are there. Thank you very much for having joined us today. And I would like to thank our speakers. So Mr. Wojciech Zentler, Head of Investor Relations at Grupa LOTOS. Thank you. And also Mr. Przemysław Krasicki, the Financial Director at Grupa LOTOS. Thank you very much. And I would also like to thank all those who have made it possible under the sanitary regime. I can vouch for it. We are all socially distanced, and our face masks are off only just for the speaking time. And thank you to all of you who have contributed to this conference in this form. Thank you very much.